Are you afraid that you are being left behind when it comes to investing? If so, there's nothing at all to be ashamed of, as getting the amount of capital most people think you need to invest can take time and a lot of grind. That's why the best way to get into investing while you're still young and building up your revenue streams is to follow our advice today. Investing isn't some exclusive club that you need a certain amount of money to join if you are smart. In fact, you can get started in the investment game with $100 or less. Stay tuned for the entire video and we'll tell you how to get started with almost no money at all. Number 1, open a retirement account. So you want to start putting away money for the future? Well, then you should probably look into making a retirement account right away. Retirement accounts hold several tax advantages over regular savings accounts, but they also come with some things you'll have to deal with as well. For one, opening a retirement account means you have some extra capital laying around, as you will not be able to easily draw money from this kind of account in a pinch. This money is truly going to be stored away for some time, and if you aren't able to commit to that because of your financial situation, then it may be best to hold off on this kind of financial hack until you're a bit more stable. Putting this money away for a few years will get you plenty of interest by the time you need to access this account, and it's a pretty easy way to get started on saving for the future. Number 2, start buying fractional shares of stocks. Fractional shares have become more and more popular, especially as apps such as Robinhood continue to blow up out in the marketplace. For those that don't know, fractional shares allow you to purchase a part of a single stock in cases where an entire stock may be too expensive. For example, if Amazon stock is worth $3,000 a share, you could maybe buy 0.1 shares for $300 instead. This is a good way to dip your toe into the investment pool without putting too much money down, and at the same time, you still get to tie yourself in with some of the most successful companies in the world. These zero-commission stocks can make investing easy and fun, and they also take some of the pressure out of it. If you are looking for an easy way to throw your hat into the investment space, buying fractional shares is a really easy way to do it. Number 3, invest spare change. The hardest stretch of investing is at the start, where you don't quite feel confident in what you are doing and also haven't experienced the feel of a financial victory just yet. During this time, it can be hard to justify putting away your hard-earned money into something you don't maybe fully understand, and that in itself can be a huge barrier of entry for people looking to start investing. Taking that leap can be pretty scary. So why not take the decision out of it entirely? Start mindlessly putting money away into a savings account, or even better, start collecting your spare change and use that money to help you invest. There are a ton of apps out there already that do this automatically for you, but you can also just start to put the money away yourself. This kind of mentality makes investing seem a lot more approachable, as it feels like money you've gathered up and not money that you are potentially throwing away. Number 4, invest in yourself. Do you have a business or hobby that you are passionate about? If so, why not make your first investment a personal one? Investments can be tricky sometimes, especially if you have a business mindset and would rather trust in yourself than a stranger. If that is what's keeping you from making passive income, break that cycle by putting some money into your own business or passion and see how good it feels to pay yourself forward. We can get so used to the grind that we can lose track on our goals, and making passive income is definitely one for most of us. Put some money into a business opportunity of your own to get used to the feeling of giving money to a cause, and this may make it easier for you to trust your money with investors too. Remember, it's a great thing to be mindful and even a little stingy with your money, but if it gets to the point where it is keeping you from making sound investments, then it's not a very useful mentality. Number 5, if you can't donate a lot, be consistent. We'll get to that in a second. I have a favor to ask of you. If you like this video so far, please subscribe to the channel. If you can't donate a lot, that's okay, but it's no excuse for you to stop altogether. Finances are a fluid sort of thing, and there are going to be lean years as well as really profitable ones. But none of that matters as long as you are being consistent. Don't get scared by the myth that claims you have to be absolutely loaded to make an investment. This isn't the truth at all. If anything, being consistent with your investments and diversifying your investment portfolio are two more important tips to follow than to just throw money at whatever looks good to you. Even just building the habit of thinking about your investments and making smart decisions with them will help you in the long run. And the more exposure you have to the industry, the more you'll start to figure out how things work. Number 6, consider a robo-advisor. Robo-advisors are automated machines that attempt to identify trends and money-making opportunities for you. Some people are so into robo-advisors that they will actually give the robo-advisor part or even full control of their account in order to make lightning-fast decisions that could earn them thousands in just moments. Now that is the best-case scenario. And there are plenty of instances of robo-advisors messing up as well. Although those instances become less and less common as the technology advances. Still though, there is a sense of risk to every investment opportunity. And even if you can spot the trends, there's no guarantee you will be proven right in the end. If you are looking for a really interesting way to make a little money off on investing though, then robo-advisors may be worth your time. Number 7, start with the bare minimum, then slowly increase how much you invest. If money is tight, then you are going to want to obviously start with the minimum amount when you decide to pull the trigger on an investment. If your instincts were right and you struck gold, the money should start to roll in ever so slowly. Once you've been proven right and some time has passed, it's time to increase your buy-in. Slowly cranking up the amount you choose to invest is an easy way to maximize your value, and it also helps to minimize risk as well. You'll have plenty of time to increase investments as you go along, but starting on the lower end helps keep you out of trouble, and so that getting burned once or twice can be more of a lesson than something to worry about. Besides, if money is tight, you're better off keeping a close eye on your investment anyway, and frequently checking and changing the amount you're investing will definitely keep you engaged with your investment opportunity. Number 8, spread your money around. Don't put all your eggs in one basket is a saying that has hung around for generations and easily applies to your financial situation. When you start to go about the process of diversifying your portfolio, you should be very careful to spread your money around as well as you can, and to be careful not to tie your investments in together. You don't want to ever have to root against a stock of your own, or to see a bunch of similar investments tank because of a controversy or unforeseen issue. Keeping your investments at arm's length from one another should help you stay out of trouble, and you should be able to avoid any kind of situation where a bunch of your stocks start to go under simultaneously. You just want to cover your bases when it comes to your money, and so leave nothing to chance. Number 9, make sure you're ready to invest. The worst thing that you could do is pull the plug on a perfect investment because you need the money. Being tight on money shouldn't discourage you from investing, but there's a difference between being tight on money and being financially stable. If a lot of your assets are already tied up in money you can't access, or you think you may need the money you're investing soon, don't put it away just yet. For one, the money you put away to invest is not a guarantee, and a crash would mean it's gone forever. And also, you just don't want to get in the habit of pulling your investments early. It's not really good business, and it also sort of puts you in a 1 step forward, 2 steps back kind of scenario too, which is never where you want to be. Number 10, go to forums or sites for help. The less money you have to contribute, the more valuable that money is. While you want to take everything with a grain of salt online, there is a lot of useful information that you can get so you are making mindful and smart investments. Social media accounts will literally dedicate themselves to discussing the stock market and various other investment strategies where you can get the thoughts and opinions of like-minded individuals before making a move. Every once in a while, these end up helping. And while you shouldn't rely on the advice of anyone but yourself, it's always a good idea to keep your eye close to the ground in case you get news of something big. In the world of business, It just matters being in the right place at the right time. It doesn't matter how you wound up there. What are some cheap investment opportunities that have worked for you in the past? Let us know your tricks in the comments section. As always, leave a like if you enjoyed the video and subscribe to our channel for more videos posted all the time. We'll see you guys next time.